Today, the debt juggernaut grinds on. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today, I want to take you through 2 or 3 articles that have come out which really underscore just how critical the global debt situation is. I think quite often we get caught up in the local discussions, and of course they're very important. But there is an international context in which we are functioning. And frankly, debt is the problem. And by the way, if you would like to support our work, then you can do this via Patreon. Here is a link. Or by making an individual contribution via PayPal. And here's a link for that too. We really appreciate all the support we've received, and this helps us to continue to be able to make great content. So please consider supporting us. And before I start as well, I should explain that I received quite a lot of negative feedback on the DFA channel relating, believe it or not, to my background. So I have taken steps, and we are now using a green screen, and we'll be featuring each time some recent photographs that I've taken in and around the Illawarra region. And today, what you're looking at is a view of my local beach, Macaulay's Beach, which is quite close to Bulli in New South Wales. So I hope you enjoy those rather different backgrounds. At least you can't now complain about the rubbish on my bench behind me. And now, down to business. The first thing I want to talk about today is a post from the IMF. Now, the IMF has been publishing a global database of debt. They started a couple of years ago, and they've just released an update with this chart, which shows the considerable growth in global debt. And in support of the chart, they made a couple of very significant comments. The first is that global debt has reached an all-time high of $184 trillion in nominal terms. And that's the equivalent of 225% of global GDP as at 2017. And that means that on average, the world's debt now exceeds, wait for it, $86,000 per capita, which is more than 2.5 times the average income per capita. So boy, does the world have a problem. The most indebted economies in the world are also the richer ones. The top 3 borrowers in the world, the United States, China, and Japan, account for more than half of global debt, exceeding their share of global output. And they also make the point that the private sector's debt has tripled since 1950. This makes it the driving force behind global debt. Another change since the global financial crisis has been the rise in private debt in emerging markets led by China and overtaking advanced economies. And at the other end of the spectrum, private debt has remained very low in low-income developing countries. And they also make the point that global public debt has experienced a reversal of sorts, because there was a steady decline up to the mid-1970s, but now public debt has gone up since, with advanced economies at the helm and of late followed by emerging and low-income developing countries. And they also looked more specifically at 2017, and they said the signals are mixed. Compared with the previous peak in 2009, the world is now more than 11 percentage points of GDP deeper in debt. Nonetheless, in 2017, the global debt ratio fell by close to 1.5% of GDP compared to a year earlier, and the last time the world witnessed a similar decline was in 2010, although it proved to be short-lived. However, it is not yet clear whether this is a hiatus in an otherwise uninterrupted ascending trend, or if countries have begun a longer process to shed more debt. New country data will be available in 2019, and that will tell us more about what's going on. But to look at 2017 in more detail, they divided the countries into 3 groups based on their debt profile. Advanced economies, they say, have pretty much had a retrenchment in debt build-up. Private debt, although marginally on the rise, is well below its peak, and public debt in advanced companies experienced a healthy decline of close to 2.5% of GDP in 2017. To find a similar reduction in public debt, we need to go back a decade when global debt was some 1.75 percentage points higher than today. And then they looked at emerging market economies, where these countries continue to borrow in 2017, although at a much slower rate. And a major shift occurred in China, where the pace of private debt accumulation, though still high, deaccelerated significantly. And then they looked at low-income developing countries, where public debt continues to grow in 2017, and in some cases reached levels close to those seen when countries previously had sought debt relief. So overall, the picture of global debt has changed as the world has changed, and there has been some decline and some shifts. But we have a lot of debt in the system. And they conclude that although a decade after the global financial crisis, the legacy of excessive debt still looms large. Now, the second thing I want to discuss tonight is a press release today from Fitch Ratings. And they entitled this release, "Sovereigns, Corporates in Focus as the Credit Cycle Turns." In their analysis, they say that credit risks across many sectors are rising, with a looming cyclical deterioration in credit conditions and global debt at near record levels. No surprise, as the IMF pointed out. However, the macroeconomic conditions and the sector breakdown of leverage in developed markets differ significantly from the last downturn in 2008. And they expect governments and non-financial corporations to be at the centre of any coming storm for credit conditions. And they said since 2007, aggregate financial sector and household debt as a percentage of GDP globally has remained roughly steady, according to data from the IIF. In contrast, government and non-financial corporates have seen their debt rise significantly, up 27 percentage points and 16 percentage points respectively. These sectors' capacity to manage the macroeconomic slowdown, accompanied by tightening financial conditions, will, they say, be challenged. And government debt GDP ratios have increased substantially across more large and developed economies since 2007, leaving some sovereigns heavily exposed in the event of a future economic downturn, with potential negative rating implications. A turn, they say, in the global credit cycle, characterised by tighter financial conditions, is more likely to be felt by emerging markets in the short term, which will face heightened volatility and capital flow disruption. And then they go on to say that non-financial corporations were not a primary source of risk during the last financial crisis. However, corporate leverage has risen markedly since then, enabled by low rates, rising equity valuations, and the expansion of non-bank lenders. In addition, corporate borrowers have largely used this funding to expand shareholder returns and M&A activity, which has far outstripped capex. And this has actually already driven negative rating trends for US corporates over the past 2 years, despite relatively strong economic growth during the period. And ratings distributions in the US corporate portfolios has changed significantly since the pre-crisis period, with BBB category rated issuers rising relative to higher investment grade categories. And the point that I will add, which they didn't mention but I think it's important, is a lot of the debt that US corporates have raised has gone straight back into share buybacks. That's a way of making their share price look better. But of course, it's not necessarily a real return. So then Fitch goes on to say that compared to sovereigns and non-financial corporations, banks in developed markets are now in a more robust and resilient position compared to the last financial crisis. Capital levels and liquidity are significantly stronger owing to a wave of regulatory reform, while reduced risk appetite and smaller loan portfolios have led to a significant reduction in banking assets as a proportion of GDP. While banks have retrenched, higher risk lending activity, they say, has moved into less visible areas of the non-banking financial system. And they say this could increase uncertainty for the financial market heading into a downturn, while adding to risks from the interconnectedness between the non-bank financial institutions and the rest of the financial markets. And I would add here that I think that the risks in the financial system are being underestimated, particularly relating to what's happening in the housing sector. Banks are highly leveraged, of course, into residential property. And now we are seeing more and more signs of home prices sliding. Those slides could well translate into losses within the banks. So whilst I agree that capital is higher now than it was in 2007, I also think the banks have significantly higher exposures. And add to that, they also have significant exposures in the derivative sector. There's about 600 trillion US of exposures, at least in derivatives in nominal terms. And what that means is that, again, there are significant risks in the system. So I'm afraid that I don't necessarily agree with Fitch that the banking system is secure and sound. Now, the third thing I wanted to talk about today was an article in Bloomberg which made the point that actually Asia is finally succumbing to the global property market slowdown that's jolted homeowners and investors from Vancouver to London, with markets in Singapore, Hong Kong and Australia showing fresh signs of softening. And they say the economic ramifications could be serious. Lower house prices and higher mortgage rates will not only dent consumer confidence, but it also leads to a reduction in disposable incomes. And they cited S&P Global Ratings, who said this in a report last month. And very importantly, a simultaneous decline in house prices globally could lead to, quote, financial and macroeconomic instability. And that was from the IMF back in April. Now, while each city in a region has its own distinctive characteristics, there are a few common denominators: rising borrowing costs, increased government regulation, and volatile stock markets. And there's also dwindled demand from a force so powerful it pushed prices to a record in many places: Chinese buyers. And they quoted Patrick Wong, a real estate analyst at Bloomberg Intelligence, who said, as China's economy is affected by the trade war, capital outflows have become more difficult, thus weakening demand in markets including Sydney and Hong Kong. And then they went through some of the significant markets across Asia. So, for example, in Hong Kong, after almost 15 years of bull markets from house prices there, home prices have now taken a battering. Values in the city have fallen for 13 weeks straight since August. That's the longest losing streak since 2008. And they also make the point that the strike rate of mainland Chinese developers successfully bidding for residential sites is also waning, tumbling to 27% in 2018 from 70% in 2017. And then look at Singapore. Home prices on the island, which regularly ranks amongst the world's most expensive places to live, posted their first drop in 6 quarters in the 3 months to the end of December. And the luxury end of the market was hit the hardest, with values in prime areas sinking 1.5%. And they say government policies are mainly to blame. Cooling measures implemented unexpectedly in July included higher stamp duties and tougher loan-to-value rules. Extra constraints since then have included curbs on the number of shoebox apartments and anti-money laundering rules that impose an additional administrative burden on developers. And then they also look at Beijing and Shanghai. And a crackdown on overheating prices has hampered sales and left values in the nation's biggest cities around 5% below their peak. Rules on multiple home purchases or how soon a property can be sold once it's bought have started to be relaxed, and there are giveaways galore as home builders try to lure buyers. One developer in September was giving away a BMW Series 3 to anybody wishing to purchase a 3-bedroom unit or townhouse at its project in Shanghai. And down payments have also been slashed, with China Evergrande Group asking for just 5% compared with the usual 30%. Harry Chin, the head of research at CBRE Group, said it's not a surprise to see Beijing and Shanghai residential prices fall given the curbing policies currently in these two markets. An index that measures second-hand home prices in Beijing has been falling since September, while one that tracks Shanghai has been on the decline now for almost 12 months, he said. And then finally, of course, they mentioned Sydney, and we've discussed in a previous post what's happened according to the CoreLogic data. Average home values in the harbour city has fallen 11.1% since their peak in 2017, and that surpassed the 9.6% top to bottom decline when Australia was on the cusp of entering its last recession. So the point I want to make here is that we are seeing signs of home price falls, not just here in Australia, not just in Sydney, but in other places around the world. Now, we have to link that back to this whole question of significant debt exposure, as we discussed earlier on, and also the fact that interest rates are rising in most countries, and of course quantitative easing is being unscrambled, which puts downward pressure on asset prices. So all of this gives you a bit of a context to understand that what we're seeing locally in Australia is not just an isolated issue here. Okay, we're probably one of the most debt-exposed economies in the globe. And particularly, of course, if you look at our ratios, we know that household debt is very high and debt to GDP is very high. But the point is, there is now some synchronization on the downside in terms of economic growth. We know China is already coming off, and we are seeing signs of issues now in the US and indeed in Europe as well. And we also know that debt is very high, and as interest rates rise, the cost of debt will begin to accelerate. So all of this, I think, if we stand back and think about it, indicates that there are some very significant issues driving not just local economies, but also the international financial system. And that's why I'm expecting to see interbank funding costs continue to rise in coming weeks and months. We see that in the BBSW here. It's rising significantly, such that now the banks have started to trim their deposit interest rates even more, because of course they're rather stuck when it comes to lifting mortgage rates. It'd be too transparent and obvious. But in fact, trimming deposit rates is much easier to do. And so again, we're seeing lots of those now being trimmed, particularly if you look at longer term deposits. And just to close out this conversation, there's one other factor to take account of. And this was a discussion published on the economic research site of the Federal Bank of St. Louis. And essentially it goes to the heart of the question, which is this: does the yield curve really forecast recessions? And the article, which was published in November, said it's well known that in the US, recessions are often preceded by an inversion of the yield curve. Now, the question is there any economic rationale for this? Well, most yield curve analysis refers to nominal interest rates. And economic theory, however, stresses that the relevance of real inflation-adjusted interest rates is probably more significant. According to standard asset price theory, the real interest rate measures the rate at which consumption is expected to grow over a given horizon. A high one-year yield signals high expected growth over a one-year horizon. A high 10-year yield signals high expected growth over a 10-year horizon. If the difference between the 10-year yield and the 1-year yield is positive, then growth is expected to accelerate. But if the difference is negative, that is, if the real yield curve inverts, then growth is expected to deaccelerate. There are a number of economic theories to explain why this might be the case. But I think it comes back to an individual's desired consumption expenditures today, which not only depends on current income, but also on the likely path of his or her income over the foreseeable future. If people expect higher future income, then they will want to consume more today to smooth out their consumption. They can attempt to do so by saving less or borrowing more. If a community is collectively bullish in this sense, desired consumer spending should rise in aggregate and desired savings should fall, leading to an upward pressure on real interest rates. Now, let's consider an economy that grows over time but where growth occurs unevenly, so the economy alternates between high and low growth regimes. Imagine as well that the economy is occasionally buffeted by negative shocks, adverse events that can occur at unpredictable moments like an oil spike or a stock market collapse. In such an economy, recession is more likely to occur when a negative shock of a given size occurs in a low growth state as opposed to a high growth state. And suppose that an inverted yield curve forecasts a deacceleration in growth, then the deacceleration will entail moving from a higher growth state to a lower growth state. And suppose this lower growth state is near zero. In this state, growth is now likely to turn negative in the event of a shock. In this way, an inverted yield curve does not forecast recession. Instead, it forecasts the economic conditions that make recession more likely. And so they then looked at the 1-year to 10-year spreads from 1985. And it's clear from the chart that the real yield curve flattened and inverted prior to each of the past 3 recessions in the US. And consistent with the theory, consumption growth tends to deaccelerate as the yield curve flattens. This is true even in non-recessionary episodes. Each of the 3 recessions occurred when consumption was growing at a moderate to low pace. So then the question is, were the recessions that occurred following a yield curve inversion forecastable? The proximate cause of the 1990 recession was the Iraqi invasion of Kuwait and the associated spike in world oil prices. The proximate cause of the last 2 most recent recessions, 2001 and 2007 and 8, were asset price collapses. It seems unlikely that the timing of these events could be forecast with precision, and according to the interpretation here, the severity of the Great Recession of 2007 and 8 was in part due to the fact that the economy was already slowing at the time of the collapse in real estate prices. Whilst consumption growth did slow prior to the collapse of the dot-com asset bubble in 2000, it grew at a moderate rate entering that recession. And so the recession of 2001 was one of the mildest on record. They conclude that a flattening of the yield curve does not necessarily signal a recession. The flattening of the real yield curve may simply reflect the fact that real consumption growth is not expected to accelerate or deaccelerate it from the current growth rate of about 1% year on year. On the other hand, a 1% growth rate is substantially lower than the US historical average of 2%. Because of this, the risk that a negative shock of comparable magnitude to past shocks sends the economy into technical recession is increased. While the exact date at which the shock arrives is itself unpredictable, the likelihood of recession is higher relative to a high real interest rate, high growth economy. So what I think this tells us is that you can't see an inversion of the yield curve as just a mechanistic thing. So if it inverts, automatically there'll be a recession. Rather, it is a signal of what is going on. But the key point that they're making, and the one I want to underscore, is that as growth slows, the risk on the downside becomes significantly higher. And that's, of course, exactly where we are. So we are more prone to a shock now because growth is beginning to slide rather than accelerating. Home prices are beginning to slide. And all of these factors together suggest to me that the major economies around the world are significantly more vulnerable now to a shock compared with previously. And if we do see a yield curve inversion, it's just further confirmation of the same thing. So I've covered a lot of ground tonight, but let me just try and put it all together for you. First, we know that global debt is very high. Second, we know a lot of this is in the financial system, but a lot of it is also in the non-financial system. That's consumers, that's households, that's small businesses who have been borrowing, and also, as Fitch said, in the corporate sector as well. The total exposure to debt is extremely high and extremely risky. And we are seeing signs in various countries now of home prices beginning to slide, and typically in my analysis, home prices slide a year to 18 months before a broader recession follows. And then the data relating to the yield curves suggests that we are beginning to move into a phase where a yield curve inversion is quite likely. And as the Bank of St. Louis piece highlighted, that indication of lower growth later is why we are getting the yield curve beginning to move towards an inversion. You put all that together and you can begin to see once again the risks that are actually sitting there out over the next 12 to 18 months. And it's really important in this context to understand that inflating debt more will simply create a bigger problem later, which is why I continue to say that the debt bomb is the biggest challenge that we face both here in Australia and more broadly around the world, and why it's folly to advocate significantly stronger lending, as of course the Treasurer did yesterday. And of course I commented on that yesterday on ABC News 24, and you can see my commentary on that. So I'm afraid more signs of more trouble ahead. If you found this useful, please like the post, add a comment and question. I read them all. And if you haven't subscribed, please do subscribe to receive future alerts. And do tell me what you think about my new background. I'm Martin North from Digital Finance Analytics. Many thanks for watching. I'll see you next time.